Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week I had the pleasure of catching up with Richard Staveley, who is the manager of Rockwood Strategic, a small company's investment trust that has performed exceptionally well over the last few years. So, Richard, this week you put out a trading statement, keep us up to date on what the trust has been doing. And in that, you said over the last 6 months, end of September, you've made a NAV total return of 12.5%, which is slightly ahead of the FTSE Small Cap Index and slightly behind the AIM All Share Index, which are two of the benchmarks that you look at. So it's been a very eventful period, has it not? A decent return, but full of incident, both on the macro level and perhaps at the trust level. So why don't we kick off? I know in one of your fact sheets a little while ago, you were not very happy with the way that President Trump's been messing up the markets. But why don't we just start with that and say, as a small cap manager, small of UK stocks, how have the reverberations from what's been going on around the world affected the portfolio, or has it at all?
Before I start, I should say thank you very much for having me on again, Jonathan. A big fan of Moneymakers. It's great to be back. I think the tariffs themselves have only had marginal effects on UK domestic stocks, really. People sort of forget that UK manufacturing exports to the US are only about 1.9% of GDP. And because I suspect President Trump has a personal affinity with our sceptred isle, we were able to get to a relatively quick agreement with them at preferential rates to his supposed enemies or people he's trying to punish. What has been the case, though, that his broader, I'd say, unorthodox presidency, in as much as he's been attacking the judiciary or other multilateral organizations or indeed the Federal Reserve and also political opponents in a way that others haven't done historically, there has been this sort of question mark come in on US assets. And that, when combined with the kind of fiscal largesse, I think he calls it his big, beautiful bill, we've actually seen the worst performance of the dollar since 1973, I think, which was slightly before I was born, maybe a year and a bit. But my history's good. And I think that year was sort of characterized by the end of the Vietnam War, the Watergate scandal and the first oil crisis. I think it might have been 74 was the last year as bad as that. But what that means is that actually that dollar assets have been under a bit of pressure. And although the top end of the S&P and indeed tech shares and NASDAQ has been pumped by AI and some quite worrying crypto-based investments, there's clearly been money coming out of American assets and coming towards the UK. And that can be seen in the FTSE 100, which is actually having a pretty solid year off the back of an okay year last year. And it's really small caps, sadly, that have not been participating very much so far year to date. I think that's for different reasons, less geopolitical or internationally or really to do with Trump at all, but more to do with the issues that we have with the current government, in as much as they've managed to inject a massive dosage of tax anxiety into consumers and corporates. And that looks like it won't end until we get this dreaded budget in November, which everyone seems to be sitting on their hands until they hear what the tax rises are going to be. And, I think it's 100% assurity there's going to be tax rises. What's happened alongside that is that inflation in the UK is the highest in G7, last print for CPI being 3.8% in a year when public sector wages are going up by 5.7% and minimum wages more than that, pushing up wages more generally. And that sort of sticky inflation, which is clearly not being very helpful for a kind of meaningful reduction in interest rates, which is what UK small caps typically perform better around if those come down. So it's been pretty difficult waters for UK smalls, and we're yet to have any meaningful or impactful government support for the smaller part of the UK market, or indeed actually the wider UK market. Now, there has been regulatory improvements, and we're seeing quite a lot of the reforms coming through, which will make the UK market more effective. Mansion House appears to have been a bit of a damp squib, it seems. I may be cynical, but it feels that Rachel Reeves basically would prefer to be standing in front of very large infrastructure projects than supporting smaller listed companies. So that Mansion House money seems to be going into interesting parts of the UK economy, but definitely not our challenge stock markets. Just to put that in context, how challenged they are, there've only been, I think it's 2 IPOs this year now. And there were only 3 last year, over 100 million quid. I think it's the lowest since the late 1990s or something like that. It really is terrible. And at the same time, this sort of drumbeat of takeovers continues from both trade, who have dominated. They've been about 60% of takeovers so far this year, and private equity, who are sort of picking off our stocks one by one. And as a result, the overall market continues to shrink in the UK. I'm going to pause there because that was quite a long one, Jonathan.
It's always good when people have got plenty to say. That's how I phrase that. Okay, so breaking it down, I guess what you're saying is that obviously Trump is doing what Trump is doing, and that's helped the UK market generally, despite some of these political and regulatory issues that you've mentioned. And small cap has yet to sort of wake up. And indeed, I believe the valuation difference between mid and small cap and the FTSE 100 is pretty wide at the moment, which is all saying that basically, we've been saying this for a while, though, that the kind of small cap revival, which obviously you would benefit from, but you've done okay anyway, we're still waiting for it, essentially, is what you're saying.
Definitely. Yeah, we are. Look, in previous cycles, going back like over the last 40 years, it's often large cap has sort of led, and there's been a sort of lag as the money's trickled down to mids and smalls. So that proves some optimism. There is no doubt that the government is still making noises about pushing pension funds into buying more domestic shares. Now, there are some people complaining that that's unfair and all the rest of it and not good on the pensioners. But if you look at our holdings of domestic equities by our domestic pension funds, we are seriously low compared to many, many other countries, even though we've actually got a more, I would say, wider and bigger stock market than many of those countries. I think the AIM market piece, I'm sadly more bearish on than I was when we probably last spoke. I've been thinking that AIM has the potential to recover, but 2 things have happened really. There used to be a bit of a regulatory arbitrage between the main market and the AIM market. Basically, you could raise money and do deals easier without as much fees and stuff on the AIM market. And that's kind of been addressed on the main market with some of the reforms, which means there's far less of a difference between the two. Secondly, we're coming up to the anniversary of when Rachel Reeves reduced the actual tax benefits of being AIM, which looks like now pretty serious wound to interest in that market. I mean, it has been a good market for the country. It's raised 137 billion since launch for over 4,000 companies, but we're now down to 650. And not a week goes by where one of the AIM ones, which are sort of slightly stronger position, or think that it's really completely unfair, are saying, actually, we're off, we're going to move to the main market. And if that means a load of our IHT holders are going to sell their shares, then fair game, because we think we'll get more interest in investing in the company on the main market. So I do worry about that. But I'd still have hope that the government are going to make some measures which could catalyze net inflows. And that's what we need. So it's been net outflows again this year. We need net inflows, and it won't turn without either that or reduced interest rates, which, as I said before, doesn't feel like it's happening at any fast pace whilst inflation hangs around where it is now.
Yeah, I mean, the inflation issue is certainly there, and we need to see quite a lot more before we're going to get any serious run of interest rate cuts.
Just to say, one thing that is important, though, is that for mainstream small cap funds, which tend to be much more diversified and tend to have a much higher average market cap than Rockwood, this is definitely a bigger problem than it is for us, because the outcome is going to be more driven by the overall market environment than their stock picking. And because we are focused, have been, and will remain very focused, and look for special sits or catalysts such that unlock value for shareholders, we are far less reliant on the market environment for our strategy to work. Obviously, 12.5% the last 6 months, it isn't to be sniffed at in the long-term history of what equities deliver for investors. But our 3-year NAV performance is now 93.9%. That's per share. that is through an incredibly difficult period for the UK stock market. So we remain confident that our differentiated approach can genuinely keep delivering despite all the problems that probably affecting a few other people more than us.
Yes, well, as I said before, I happen to be a shareholder in this trust and I can't complain about the performance. You're absolutely right over a 3-year period, hard as I might try. But it's not been all plain sailing for you. The last fund fact sheet you put out was back in the end of June. And obviously you've had a couple of disappointments, shall we say, individual disappointments. Let's get them out of the way first of all, shall we? So just tell me what happened with these two. Are they indicative of more general problems or are they company specific? I'm talking about RM PLC and I'm talking about Argentex PLC.
Let's do the worst of the worst first.
Yeah, get them out of the way.
I can tell you'll be excited about RM by the end of the time I explain where we are with them. But with Argentex, I have to say, I've now managed small company money for over 25 years, and this really was quite a shock. The business does FX services and has repeatedly stated to investors in its annual report and generally that it is a agency business facilitating transactions for those that want to have a better price than the mainstream banks and at better rates with high levels of service than the banks typically provide. They produced results earlier this year, which were positively framed and slightly ahead of expectations. In the couple of weeks that followed, the directors all bought stock. And I think about 14 days after those results, the annual report came out, fully audited, with clean opinion, stating that the business was all fine, that it had loads of net cash, and that regular stress testing was undertaken and risks were managed appropriately. At warp speed, it was announced over the weekend, and we were heavily involved over the weekend, that the management have, in my opinion, been grossly incompetent, really grossly incompetent, and had allowed their latent positioning in client money to be out of control relative to their balance sheet. And the board themselves clearly also lacking in oversight and testing of that management team. So they went from huge amounts of net debt to financial distress almost in 10 days. We were offered to be part of a rescue, which we declined. And following that point, the business actually received multiple takeover offers in its distressed position to take control of what was quite a large client base and a position in the market. It does appear that the people that were sort of winning offer has also lost all the millions that they put into trying to do that rescue. And we've lost all our money. And it's very sad. But, an old investing friend of mine, a man called Tim Steer, who's now retired, but has written an excellent book called The Signs Were There. I really don't think the signs were there in this investment. It's a kind of black swan. And you just have to put that down to one in a way. I think what we've learned from it in two parts is that our position sizing was right. It was one of our smaller holdings. And that position sizing was linked to the fact there was a very large shareholder who was really in a dominant position relative to us. And they had someone on the board, and we had been engaging with them because we felt the board wasn't effective as it should have been about board change for some time, but they've been dragging their feet, and they're in a position because of that large holding to do that. And it's just reinforced to us the importance of that factor when we take on positions, that we're managing that in the risk profile of the holding.
Right. So I guess you have to ask yourself, obviously, whether you did miss some signs. In retrospect, one always has to do that. But you think this is, well, was it incompetence or was there deception involved as well, do you think? Or perhaps it's too early to speculate on that.
Yeah, I think it's unlikely. If you just assume that any company that the directors, of which I'm a director of one of the holdings in Rockwood, the amount of information available to directors and the board regarding their company is infinitely more than what investors see and understand and know. And I think the fact that the directors were all buying stock literally in the run up to this event happening shows that they really were not clear of what they were doing or what risk management was going on. And to get into the weeds just very briefly, rather than a full inquest, is that it turns out there was a type of product called a 0-0, where for sort of favored clients who were going to do lots of business with them, they had on a very low level initially started saying, look, guys, if you want to do this hedge I'm just going to use a completely made up example, but let's say someone like BlackRock, who might be a client who are trying to hedge their management fee from the euro class into the sterling class. And they're not going to go bankrupt. They're not going to have a credit loss, which is the main risk that Argentex were taking, that they took on, that the company went bust, that they were helping do the hedge. The BlackRock say, we want to do this, and they say to BlackRock, well, actually, you know what, you don't have to post any initial margin and you don't have to post any variation margin. We'll handle that at Argentex. That'll be fine. And obviously BlackRock are very happy about that. The trade completes and everyone's fine. And as long as they've got someone going one way at euro dollar and someone going the other way at dollar euro that matches each other off, that approach could technically work. But essentially, the amount of that activity they were doing increased materially. It was essentially not what they were saying they should have been doing as essentially a business, because it moved from agency to actually having a principal position, and meant that they needed to be managing that book and those exposures and those hedges infinitely better than they clearly were. You could argue if they were standing up, in front of the beak, if the FD, there's no doubt that the move in the dollar around about the time was something that had been unpredicted by many market commentators, but that in itself shouldn't have been an excuse.
No, exactly. Okay, well, that's one you had to learn from, I guess. But what did that cost you actually in terms of pence per share? Did it cost you a lot?
It cost 2.3% of NAV.
Okay. So then let's quickly get RM out of the way. I mean, that's a less troubling story, as you say, but you were unhappy about it back in the end of June. This is an educational company, as I recall.
Yeah, it's in the top 3 holdings in Rockwood, and it remains there. To be clear, we're up over 90% from our average purchase price of the company, and we're about 3 years in since we purchased the stock. As you say, it's in the education sphere. It has 3 divisions. One does outsource technology solutions for schools and groups of schools, where they literally run the broadband and run the schools' intranets and all that kind of activities, which is outsourced to them. Not very techy overall, quite sort of low margin, but sticky public sector clients. The second division is a market leader in the provision of resources to schools. I think they touch nearly 90% of all UK primary schools. This is everything to aid the classroom. So teaching aids, curriculum-based products. They design quite a few themselves. The brand's called TTS. It's well respected in the market, even through to little robots, which help kids learn how the basics of coding when they're at primary school and that sort of thing. That's a kind of distribution business with roughly about 70 million of sales. And then they have this awesome, what I call the jewel in the crown, which is their assessment division, which marks exams. And it's got a long history of doing that. I think this summer they marked 15 million exams. Not something to cock up on because of the obvious repercussions of that. They've done it for many years, and they do it for a range of the top people, including the ICAEW, ACA accounting exams, the Chartered Tax Account exams. They have Cambridge Assessment, which has lots of A levels and other qualifications. And their largest client is International Baccalaureate, who they won a huge contract with 9 months ago to digitalize their whole process over the next few years. And that's essentially underpinning the creation of a digital platform, which they're 2/3 through building, which is going to unlock the digitalization of exams globally and also in the UK and for IB. Just to be clear, that part of the business is kind of known as ed tech. It's high margin, it's recurring revenues. It will be a very profitable and very prized business. I'm disappointed because 3 years ago, the former management team nearly blew up the business with a failed ERP system implementation and a botched site move. And they've all been fired. So we've got new chair, new CEO, new finance director, new head of transformation, new COO, new head of HR, new heads of all 3 divisions. And that team have been sort of clearing up these guys' mess. But they did inherit a very stretched balance sheet with over 50 million of debt, nearly 60 million now, I believe. And that meant that they were on the naughty step with the banks. But the new management team, who've got a long history of sorting out businesses and delivering for investors, have managed to keep the banks on side and agreed essentially with me from the outset that the only way to sort this out was to break up the group and to sell off the first 2 divisions I mentioned and either stick with the final one because it should be valued very highly, or maybe eventually sell that. But that was literally, I was having those discussions 3 years ago, so I'm really quite frustrated they haven't announced any of them yet. I am expecting them to announce them during 2026, and that will start the process that would unlock some of the parts the business has. The weakness was actually a little bit technical for two reasons. Firstly, I mean, the education budgets are a bit under pressure because of just general public sector pressures, but that in itself is not really a major issue for these guys. The assessment stuff is growing nicely. The problem was that they had a kind of slightly strange shareholder appear on the register who was based in Hong Kong and had some interest in education and built up quite a big stake. And then he decided during the summer that he wanted out. And that created quite a lot of volatility, which you'd imagine in a company that's capitalized at about £75 million. Now, just to remind listeners what Rockwood does. So we bought this company, started buying this company, was 25 million market cap. As I said, our average is up about 90%. So we continue to build, and it's now valued at about 75 million on market cap. Our sum of the parts is 170 million quid for what we believe will be unlocked by a breakup of the group. We've now bought 15% of the company, and we also proposed a director to the board and to other large shareholders who were supportive, and that individual is currently a senior non-executive director. We're still, we believe, one of the only investors to actually have gone to the sites of this company, although I can't say I know the diaries of all the other shareholders, but the company tells us they haven't had many people come and have a look round. And we've had multiple meetings with them over a period of time. So we do think when they actually get on with it, or they're more effective at getting on with it, it will unlock this beautiful little butterfly in the assessment division at the end of that process. And for shareholders like yourself, Jonathan, we'd expect this to add probably 10% to NAV over the next 2 years itself.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. We should talk a little bit about the good news, I guess. We have made a positive return, as you said, for 12%. And your shares are now in the all-share index and the small companies index. Has that actually had any impact? I mean, people often talk about that as being a potential catalyst for some more shareholders coming in. Have you seen that?
Well, we've continued to grow. So as you're aware, the net market's been net outflows. We've been raising money. In the first half, we actually increased the share count by 25%, which actually means that the fund itself, combined with performance, has grown by 267% over the last 3 years. Year to date, we've raised over £30 million into the fund. That's on the back of 20 million in 2024. And there's no doubt that some of that 30 million, I think, was the trackers buying a few Rockwood. Passive at last has some positive impact on Staveley. I didn't think it'd ever happen. But yeah, so I think we issued a few shares to a few trackers. There's no doubt that now we're 135 million. We are getting a bit more interest than we were when we were 35 million. And, it's kind of pretty proud. We're hopefully going to get a bit of good news. We've been nominated for a few industry awards in recent weeks: Investment Week Company of the Year, Citywire Company of the Year, and Quoted Data Company of the Year, and all in the small companies space. But I also think that part of that is because we've been very clear about these really ignored different style investments that Rockwood can make. And if you take a company like Capita PLC, well known to private eye readers for its jokey name, that company is now a top 3 holding for us. We've actually owned just over 3% of the company now, a company that used to be in the FTSE 100. And in the last 6 months, Capita's up about 68%. And it's still on a very, very low multiple. 3.5, 4 times EBITDA, P's of around about the same, with 2.5 billion of sales, and a management team that's really being effective. So it was highly leveraged. It's now not. It did have a huge pension fund problem. It now hasn't. It was heavily loss-making. It's about to become free cash flow positive. And if we take that business, which, by the way, not everything we have is a sum of the parts, like the RM I've just been talking about, but Capita is also a sum of the parts because its public sector division itself, which is performing very, very well or solidly, it could have a slightly better growth rate. We'd like to see a slightly better growth rate, but it has sales of over 1.3 billion. It's making nearly 8% operating profit margins. It's converting most of that profit into cash. We think if that was a standalone business in this sort of unloved UK stock market, it would still be valued about 900 million quid. And the current market cap of Capita is now 350 million quid. We started buying it when it was 225 million quid. We have a target for the overall business of £1 billion market cap. So it's those sort of anomalies which just don't feature in other people's portfolios, which keep sort of appearing in front of our eyes, as it were.
Well, that's good to know. You say you've got obviously the market cap now 135 million. Just remind us what you think the capacity for what you do actually is.
Yeah, we've said consistently £250 million is the capacity. So we've got scope to nearly double again over the next few years. The reason why it's 250 is, as you might imagine, it is a little bit of science, a little bit of art. But let's take something like the BlackRock Smaller Companies Investment Trust, one of our competitors. They have less than 5% of their portfolio in stocks under 250 million market cap. And it wouldn't surprise me, I don't know their portfolio in detail, but if those are ones that started out at a higher market cap and have ended below 250, same with Aberdeen and other larger smaller companies funds. So what we find is that when stocks get below 250, slightly arbitrarily, the kind of risk teams all sort of jump in and tell the managers that often also run OIC funds alongside their permanent capital investment trust vehicles and tell them that they've got not enough liquidity in those particular stocks and they should reduce them or not have as much. And, the managers don't like being sort of pestered by these sorts of people. So they tend to just avoid it altogether and play in a much higher market cap. That means it's a really wide space. And also because of the problems caused by all the MiFID regulations a number of years ago, and indeed the lack of basic nutrition from the IPO market, the stockbrokers are all crying into their milk if they can afford it and don't really cover a lot of these stocks either. So you've sort of got very limited stockbroking coverage. You've got even small cap funds not really buying these stocks. And as a result, they tend to be what Howard Marks calls, highly inefficient markets where he'd prefer to spend his time. So we're sort of following his lead and looking for sort of gems in there. The good thing is with a Capita, for instance, and this is how it really works perfectly, is that down at 225, everyone is forgotten, can't care, doesn't care, or doesn't want to be involved and are told not to be involved. But if we can back a turnaround and recovery in prospects, strategic change, disposals, and all the rest of it, then as it starts to recover, it will become a market cap where those funds can start relooking it again. And guess what? Canaccord Genuity, the Canadian stockbroker, actually recently initiated on Capita, saying that they thought it was worth £900 million. And it's really refreshing to see coverage of one of our companies just appearing and also sort of agreeing with us that significant anomalies can exist at this part of the market.
It works both ways, of course, inefficient markets, don't they? I mean, they create opportunities, but then, as you say, you've got to somehow find a way to stoke the engine to get it back into a place where it can become more efficient.
Yeah, that's absolutely right. And and that's our approach. So what we do is we take stakes of at least 5% so that we can call an EGM and make changes. And our hands are all over a few changes in recent months, not least the new chair at STV that's just been announced, or changes at a few other companies we've announced. So it's that combination of using our stake, working with other stakeholders in this part of the market to try and agitate for change. You can sort of capitalize stuff. But the risks are around the illiquidity if you don't have the influence to manage the illiquidity. But it doesn't necessarily mean you have to be taking high risk bets in terms of either business models or otherwise. We don't have any sort of whizzy, unproven AI or biotech or mining stocks or anything like that. Of our 24 holdings, 10 have net cash. We've got 15 of the 24 we own over 5% of the company. We've got 12 that are trading below book value, which is just unbelievable because the US market's on 5 times book value. Just to give you a context, nearly half the portfolio are less than book value. So that is a good way of explaining it. So we've got broadly well-capitalized businesses, companies that aren't like RM. We have pathways to being well-capitalized. We would expect the sale, for instance, of that resources division I mentioned to wipe out the entire debt load in one foul swoop if it got a sort of fair result for that division. And we're backing companies that used to make profits, or their peer group or competitors make decent level of profits, and they don't because they've just been through a period of normally poor operational control or poor management. Capita being the case, but TriFast is another one. A business got fasteners. It makes nuts and bolts. It's been around for 20 years. We've been behind the changes there. There's a new chair, CEO, finance director, heads of divisions. They think margins troughed at 3.3%. The company used to make 10% year in, year out. They're now up to 6.5%. I have no doubts they'll get to at least 10, but we're up 15% of the equity at Harwood in general. And my colleague Nick Mills, son of Christopher Mills, is on the board of TriFast, and we've been hugely supportive for that turnaround, which continues. The stock's still on a very low multiple, literally sort of 10 times sort of type of PE.
So if we look ahead, what can we expect from Rockwood in terms of portfolio activity? What I'm asking is how many of your holdings are perhaps approaching a realization value that you would be happy to see, or how much of, as it were, the sauce is still in the pudding in the oven? That's a rather laboured analogy, sorry.
Well, I suspect some of your listeners won't know the portfolio particularly well, but just to remind, the top 10 are about 60% of the portfolio, and we're at about 8 or so percent cash. So the majority of what happens will be driven by that top 10. Vanquis Banking Group, which is the largest position at 9% of the portfolio, used to be called Provident Financial, the doorstep lender. And again, is going through a major turnaround that we've backed. We're up over 100% already. However, we think that can move up at least another 50, possibly another 100% from here. So we haven't sold a single share yet. RN, I just explained, has more than 100% upside. Capita, as I explained, is 330. We think that's worth 900 million. TriFast, we think there's about 100% upside from the current share price if it gets onto one-time sales. Just to be clear, it's on 100 million market cap, and it's got about 240 million of sales. Filtronic has been a massive winner for us. It's actually been a 10-bagger within Rockwood, and we've sold over 50% of our shares now in Filtronic. It's still a top 10 holding, and it's difficult to sell something like Filtronic in anger when it's announcing its largest ever contracts with SpaceX, has net cash, is beating expectations. We think there'll be more upgrades, but we have taken quite a lot of profits in that stock. So that's the most likely to continue to be carefully realized into good news. Capital Limited is still trading at a discount to book value. It's a company that does drilling services around the world for major and minor mining companies, not least biased to copper and gold, which are helping it quite a lot. So we think there's loads of upside still there. Funding Circle is about to, we think, beat its expectations for 2026. That will put it on about 5 times EV/EBITDA, and they've stated they've got over 100 million of unrestricted cash still on the balance sheet. So we think that could continue to motor very significantly now that the tech platform they've got is basically profitable. Restore, P of 10, run by the amazing Charles Skinner, and its 15-year PE average is 19. It's on a PE of 10 because of what's going on the AIM market. We think that's absolutely nuts. Just to remind you, they do document storage, which is essentially collecting dust and cash. And they're, it's a duopoly with Iron Mountain, brilliant business. So loads of upside there. Saatchi has been weak of late. We've been adding to that position. They announced a small bolt-on acquisition this morning of this recording, but that is on a PE of 8 times and being priced as if it's a out-and-out ad agency. It, in fact, has a small ad agency and does totally other specialisms with governments and non-cyclical, non-economic organizations, which make up the majority of profits. We think it's a real blind spot for investors, but again, on AIM, so suffering there. But I can tell you that there's a lot of M&A going on in the wider media market, and that does feel vulnerable to us with net cash on the balance sheet and a sort of strategic shareholder as well that bought a stake. You probably haven't interviewed her, but Vin Murray from Advanced ADVT, it's got a slightly strange name, her trust, but backed by the Marwin guys. And James Fisher, one of our industrial turnarounds in the top 10, It's a business where, again, the new management team have really stabilized that business, paid down the debt, and we're waiting with bated breath for a turnaround in their defense division, which was basically break even for last year and kind of loss-making before. But the most recent news there is that the order book has gone up by over 50% for the defence division alone to £300 million. The market cap is 180 million quid. And we would expect that stock to go into an upgrade cycle and become very attractive to mainstream small cap funds shortly once those upgrades start. At the same time, that's the top 10. I'm not going to go through the rest of the portfolio, Jonathan. It's not fair on you or the listeners. But within the others, there are 3 or 4 other holdings which are very much in the realization phase, either because we are agitating for realization or we expect them to be realized. And it's probably quite a good one to finish up on, because for those that don't know UK small cap or know the kind of opportunities that we are sitting on here in Rockwood, Centaur Media, which is a business that Rockwood has a big stake in and Harwood does too. And combined, we have 29.5% of the equity of that company. I went onto the board for a period and know it, I would say, extremely well as a result of that, but came off the board about nearly a year ago in order to allow an appointment of another Harwood individual, not working for us, but our proposed candidate, Martin Rowland, to become chair and shortly after exec chair, following which the CEO left. And he's able to spend the time on it that I couldn't as Ned, in terms of really roll up in his sleeves, on a multiple days per week basis. And he has announced so far the sales of The Lawyer, which Centaur owned, for 43 million quid. He sold Mini MBA, which was their online MBA educational course, for significant amounts of money, and also Marketing Week. The business has 2 further businesses, which we expect them to exit or sell. And it started this process with decent cash on the balance sheet. What does this all lead up to? Where's Stavey going with this? The reality is that all adds up to, known in the public domain, that they have 71 million quid of cash. And the current market cap today is 60. And they've got these 2 other businesses. They've also said publicly they are going to return significant amounts of capital in short order, having discussed it with shareholders. So Centaur Media, as we speak, is just under 3% of the portfolio. We're trading less than cash. So that's the sort of thing. And it's all in plain to see. And I think that just encapsulates sort of both the opportunities in small cap, how Rockwood works. And we will end up, when that process finishes, we think, delivering a pretty exciting and above our target returns investment.
Yeah. So also perhaps a reflection on the state of the UK stock market, of course. There are these stocks trading with cash more than their book value. Indeed, that is an interesting situation and statistic. Okay, so I think that wraps us up here, Richard. It'd be very good to talk to you again. As I say, nice to hear a voice that is full of, positivity and optimism a little bit, despite some of the other things that are going on, which you have alluded to, like the fiscal extravagance of the government and failure so far to actually implement a growth agenda or help the UK stock market revive. So let's look forward to the next time, and let's hope you can bring back a similar story next time.
I'm looking forward to it, hopefully, Jonathan. So thank you so much for your time and for everybody that's been listening in. I want to tell everyone one final thing is we're about to launch our new website in a few weeks' time. So keep an eye out for those guys that haven't looked at us before. But if you wait until our interims, we should have a new, quite attractive website, which we've sort of polished up. Now we're a slightly bigger vehicle.
Okay, that I'm sure we'll do. So that was Richard Staveley, the manager of Rockwood Strategic, the small cap investment trust, ticker RKW.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.